Hello everyone, we are Universitas Indonesia students and today we are going to present to you about our comprehensive analysis regarding company valuation as our final project. Before starting our presentation, I would like to introduce the members of our team. My name is Joshua Timothy and on this presentation I will be accompanied by two of my colleagues, Evie Amandha and also Angga, Fahmi, Dirga. So in these presentations, we are taking cigarettes industry as the sector that we are going to analyze. In this presentation, it consists of 4 parts. First, about company profile and also its financial condition. Second, about the forecasting of our chosen company. Third, is about the equity valuation. And lastly, is about all of other aspects regarding company valuation. So without further ado, let's start the presentation. In this presentation, we are taking cigarettes industry as the sector that we are going to analyze. So for this presentation, we are taking PT Hanjaya Mandala Sampoerna Tbk as our chosen company. It is further known as HMSP or Sampoerna. So PT Hanjaya Mandala Sampoerna Tbk is an Indonesian-based company that primarily engage in the manufacture and also trading of clove cigarettes, or locally known as kretek. The company produces both hand-rolled kretek and also machine-rolled kretek. There are lots of products that have been sold by PT Hanjaya Mandala Sampoerna such as Sampoerna A, G Samsu, Sampoerna U, Sampoerna Kretek, and also Marlboro. So we are standardizing its financial statement that consists of, first, the standardized balance sheet. Second, the standardized income statement by function. Third, the standardized income statement by nature. And fourth, the standardized cash flow using the direct method. The second part of this presentation is about forecasting. So in this part, we are going to forecast our chosen company. Before starting our forecasting, we are dividing into 3 levels of assumptions. First is the macroeconomic level. In this macroeconomic level, there are 3 points. First, about economic growth. In 2018, economic growth was 5.17%, higher than 2017 of 5.07%. So in 2019 target, it is stated in the 2019 APBN for the target is 5.3%. Second is about inflation. Inflation in 2018 is 3.13%, and the target in 2019 is 3.1%. Lastly is about exchange rate. The exchange rate of the rupiah against the dollar in 2018 is at 13,882, and the 2019 target is at 14,400. The next level of assumption is in the industry level. So there are 4 points. First, about the excess tax. It is stated that the excess tax will increase in 2020 at 23%. Next is about consumer preferences. The middle and upper consumer preferences tend to shift to healthier cigarettes. Third is about anti-tobacco campaign. So the cigarette industry is often hit by overly publicized propaganda such as the anti-tobacco campaign. And lastly is about framework convention on tobacco control. The FCTC is accused of aiming to kill IHT because in FCTC there are 38 articles that explicitly regulate the prohibition of the distribution of tobacco products. The next is about company level. So there are 3 points about company level assumption. First is the distribution channel. So the company sells and distributes cigarettes through 106 sales office and distribution centers of the company and 33 exclusive zonified distributors, or called EZD, throughout Indonesia with 7 zone representative offices. Next is about affiliation with foreign company. So the company has a main parent entity related to financing, namely Philip Morris International Incorporated, or can be called PMI. And third is about more secure financing. The company has a low ratio of total liabilities in total assets and debt to equity, reflects the capacity of the company who are strong in financing and their growth using their own sources of funds and also their own equity. So in this section, we are going to describe our assumptions regarding several subjects in using to analyze and to making the condensed forecast. First is about its sales. From the historical average data, we are taking stable growth rate is at 0.27%. So for 2019, 2020 and also 20 and 21 growth rate, we are adding that amount, the 0.27% with the past year changes. Next is about NOPAT and NOPAT margin, or can be called net operating profit after tax. So there are two factors that affect NOPAT. First about increase in excise tax, and also second about the sales, general and administrative cost stickiness. So we're assuming that both factors will be constant, and also the NOPAT will. So we are assuming that the NOPAT will increase by 2%, and also the NOPAT margin will increase by 0.23% based on the historical average data. Next is about net interest expense after tax. So the net interest expense after tax will increase by 10% each year based on the historical average data. The next subject is about net working capital and also net working capital per sales. So HMSP working capital consists of of 5 parts. First about the operating cash, trade receivables, inventories, trade payables, current assets and current liabilities. So it is predicted that the days inventory will decrease, but there will be a slight increase in 2019 due to the SPM excise taxation. Next is non-current non-operating assets and also net non-current non-operating assets per sales. So it is assumed that the non-current operating assets will be constant during 2019 until 2020 with an average increase of 1.67% per year. So the net non-current operating assets per sales will decrease by 4%. The next is investment assets, non-operating investment. It is assumed that the value of investment associates is constant, while the value of investment property decreases due to the depreciation. So that overall investment assets will decline by an average of 2% per year. Lastly is about capital structure and debt to equity. Since 2009 to 2015, HMSP is no longer uses loans as a form of financing. This full equity financing policy is assumed to be constant for the next 3 years, and we assume that the debt will keep decreasing by 0.25% and the equity will increase by 0.25%. Based on our forecast assumption that we have stated, we can make a condensed forecast for our chosen company HMSP. So here are the condensed forecasts for HMSP. The next part will be presented by my colleague Evie Amandha.
Thank you, Joshua Timothy. In this part, I'm going to present about the valuation assumptions and method that we use. These are the list of assumptions that we use to calculate the valuation of HMSP. The first one is risk-free or RF. We use the RF based on the average yield to maturity of 10-year SUN or Surat Utang Negara. We use SUN because we believe that Surat Utang Negara is only exposed to the country risk such as political risk and not exposed by the company risk itself. The second one is market risk or RM. We calculate the RM based on the geometric mean or geomean of IDX composite for 13 years from 2007 to 2019. Why we use the geometric mean? Because we believe that geometric mean is more accurate than the arithmetic mean to calculate the true return of volatile number. The third one is the beta equity. We calculate the beta equity using the regression method between the HMSP and IDX composite for 13 years time lag. From same with the RM, we use the 13 years from the 2007 to 2019. Why we use 13 years for the time lag? Because the longer the time lag, the more accurate the calculation. for the beta equity. After we got the RM, RF, and the beta equity, we can calculate the required rate of return, or also known as expected rate of return, also known as CAPM, or capital asset pricing model, for 5.11%. And also the next is stable growth rate, that already mentioned by my colleague Joshua Timothy before, and average dividend payout ratio, that we got from the average of dividend payout ratio that we calculated for the valuation, and also the cost of debt that we got from dividing the total interest expense with the total debt, and cost of equity that equals to CAPM. So we can calculate the WACC, or weighted average cost of capital, for 4.76%. The next is I'm gonna explain about the method that we use to calculate the valuation of HMSP. The first method is dividend discount model, or DDM. The second is discounted cash flow model, or DCF. We calculate the DDM. We also include the DDM because HMSP also distribute the dividend. I'm gonna explain first about the DDM. These are the lists that we have to focus when we calculate the valuation using DDM, or dividend discount model. The first one is dividend payout ratio. That means is dividends paid relative to net income. So we get the dividend payout ratio by dividing the dividends paid by the HMSP net income. The second is average dividend payout ratio, by average the dividend payout ratio, because we calculate the actual dividend payout ratio for 3 years. And the third one is clawback ratio, that indicates how much earning retained after the dividends are paid. We get the clawback ratio from 1 minus the DPR. The fourth is sustainable growth rate. The sustainable growth rate is the growth of the company without the help of the additional help of the finance growth. The fifth is the average sustainable growth rate. And next is the EPS, or earning per share. It also means that how much money that company makes for each share, We get the EPS by divided the NE by the total shares. The next is estimated dividend, or also known as forecasted dividend. We get the forecasted dividend by EPS times average dividend payout ratio. The next is terminal value. These are the formula for terminal value, that we got the present value of the terminal value. Terminal value, also known as the value beyond the forecasting period. The next is intrinsic value. We got the intrinsic value from the sum of all of the PV, from the PV, or from the estimated dividend, and also the PV of terminal value. Intrinsic value, also known as the inherent value. These are the calculation that we got from the dividend discount model. These are the intrinsic value, and the current market price is per 10 November 2019 is 2060. This information is available in the market, or you can check it in IDX website. So we can compare the intrinsic value 2019 with the current market price. So we can conclude that intrinsic value is higher than the current market price. so the valuation is undervalued, and we can recommend that you should buy the HMSP shares. The next part is discounted cash flow model, or DCF. These are the lists that we have to focus when we calculating the valuation using discounted cash flow model. The first one is free cash flow to the equity, or FCFE. Basically, we can calculate FCFE with net income minus book value of asset minus book value of debt. FCFE, also known as how much cash available to the equity after all expenses, reinvestment, and also debt are paid. After we got the FCFE, we PV the FCFE. And also we use the CAPM for this calculation, stable growth rate. And after we got this item, we can calculate the terminal value. Also, we PV the terminal value. The sixth is equity value. Equity value basically is the sum of PV of FCFE plus PV of terminal value. Equity value is also known as total value of the company that is attributable to the shareholders. The seventh is market capitalization per price per share. Market capitalization per price per share is basically the market capitalization divided by the share price. This information for market capitalization and share price is available in the market. These are the result of our calculation based on discounted cash flow model. These are the market capitalization per price per share, and also we got the equity value. We compare the market capitalization per price per share with the equity value, so we can conclude that the equity value is higher than the market capitalization per price per share. So the valuation is undervalued. So we recommend to buy the HMSP share based on the discounted cash flow model. The next part will be presented by my other colleague, Angga, Fahmi, Dirga.
Thank you, Evie Amandha. Now I will talk about other aspects, it's including financial distress and debt valuation. First, I will talk about financial distress. We will use the Altman Z-score to determine the financial distress of HMSP. The output of Altman Z-score can show the likelihood of company bankruptcy. The Altman Z-score is based on 5 aspects. First, liquidity. Second, profitability. Third, return on asset. Fourth, market leverage. And the last, sales generating of potential asset. Now, we continue with our calculation. For the liquidity, we can get from the net working capital. And for both years 2017 and 2018, we can see positive numbers of net working capital of HMSP. It's showing a good sign. Second is their profitability. We can get this from their return earning. And the HMSP return earning from 2017 to 2018 is increasing. A good sign too. Third is return on asset. We get it from their EBIT. And their EBIT, like their return earning and their net working capital, for both years is showing a good sign because it's increasing. And fourth is market leverage. The market leverage, we get it from their market value of their equity and book value of the total liability. Okay. And this market leverage is showing how solid the HMSP financial situation. The last is sales generating of potential asset. And this number can show you how good the HMSP sales for both years. Based on the calculation, we get the score, what we call as the Altman Z-score. Score below 1.8 means it's likely the company is headed for bankruptcy, while companies with scores above 3 are not likely to go bankrupt. Investors Investor can use Altman Z-score to determine whether they should buy or sell stock if they are concerned about company's underlying financial strength. Investor might consider purchasing a stock if its Altman Z-score value is closer to 3 and selling or shorting a stock if its value is closer to 1.8. And for the HMSP, their gut score is a very, very good score. It's 4.8 for 2017 and the 2018 4.7. It's way above 3. Last, I will talk about the debt covenant. We use the debt covenant based on two aspects: financial leverage and solvency. This is our calculation. The financial leverage, we can get it from debt to total asset and the debt to total equity. If we look at their debt on the annual report, it shows how low the HMSP debt is, why their debt to total asset and their debt to total equity is nearly 0. And their solvency is really, really high. It's because their interest expense is so low. It's touching in the 100 times that their EBIT can cover their debt obligation. Based on this calculation, HMSP show a high financial flexibility. It's very favorable for the investor for doing business with HMSP due to the low leverage ratio. With the HMSP current income, it means that it's so likely for HMSP to meet their debt obligation. To sum up, from our calculation based on DCF and DDM, we recommend to buy HMSP. However, the sentiment rise by the increase of excise can significantly impact the equity value of HMSP. HMSP need to create reactive strategy to face the challenge. If HMSP fail to meet the challenge, then the recommendation could be changed into hold or sell. That's all from us, and thank you very much.